And mostly we're in office. So I know some firms are remote. We do have, kind of some hybrid positions. But a lot of people are in the office and have been, I guess right after COVID, I feel like it was slightly remote. And then for the most part, we've been back because there's just so much that goes along with collaboration, and we just learn so much from each other. But we're about 45 people. We've got tax, we've got attestation services, which would be audits, which I think is the class that you're in right now, reviews and comps, and then we've got an accounting services. So those are kind of the three big ones: tax, audit, accounting services. In accounting services, we assist people or clients with kind of their QuickBooks, and either teach them how to run their own businesses in their own accounting, or we can kind of help them along as well if they don't have somebody to do that. And then we also provide valuations. So for being a smaller firm, we really kind of have a robust group of services that we're able to offer our clients. We've been around for 50 years, so we've really maintained a lot of relationships with our clients. Some have been around that long. We're close to it with second, third generation kind of with us still, and we're always growing. Let's see, what else did I want to share here? I've been in public accounting since I started my internship with KPMG in '97, so it's been a while. Had an internship all the way through, enjoyed that I was able to see what it was like on the day-to-day kind of side of accounting, and to see what I liked, because I think kind of as a student, it's hard to say, okay, learning from a book, this is where, you might have an interest, but then to feel what it's like on a day-to-day basis, kind of do some of the assignments, real life, it's really invaluable, I think, to have an internship to be able to figure out what it is that you like and what it is that, you find that you're good at. So that's why we really, push for our internship program, and we honestly hire quite a bit from our internship program. And it's been a great experience to see if candidates fit in our culture, and likewise if they enjoy us. So we kind of have, there's 5 different core values that we have at our firm: education, integrity, people, care, and trust. We hire by those, they say we fire by those. That thankfully doesn't happen too often, but we really have worked hard to build a culture of people that care about each other, care about our clients. Because of all of that, we kind of do really good work. So we just got done with tax season. I still haven't quite caught up from my sleep yet because it was a little rough. Audit kind of tailed down, before the end. And then for tax, which I'm a tax manager, it's like live, sleep, eat tax, before the weekend, or at least a couple of weeks before the deadline. So I'm just recovering now, but we had so many laughs. It was just as hard as it was, and really trying to deliver the best product to our clients, we had fun doing so. So it's kind of hard to say that about a lot of places, but here I really believe that's the case. And again, we've worked hard to make sure that we hire using those core values. So a little bit about our internship program. It runs from the core program that we have, and the most formal program runs from mid-January to mid-April. Usually students are between a junior and senior years. We've had some sophomores, we've had some grad students. So we've had, we'd like students to have a tax class or to be going through one, but we've realized that that's not necessarily, important, but it would be nice just so that you'd understand more of what you're coming into. It's heavily tax-based. We also try to get in some audit work if possible, depends on the student's schedule. And, from the tax side, you're really learning how to prepare business returns, individual returns, some trust returns, and you start out with kind of the 1099 process, because clients have to issue 1099s to their vendors. So you really get to see, I feel like some of the bigger firms, and I went through a little bit of that to kind of wine you and dine you, and okay, like here, come in for an internship, as they call it, and they show you very cool things, but you never get to do like the day-to-day work. I feel like at a smaller firm, you kind of get that experience to be able to really see if you could see yourself doing that, for the next few years of your career. We usually have 5 to 6 interns. And again, January through April, we love to have our interns be able to give us 40 hours a week if it's possible. A, if they can take the class for credit, and then B, if they kind of have some night classes or kind of block their schedule. That's kind of what I did in college. But you get the max out of it, you know, when you're able to give those hours uninterrupted, because then you're able to just build upon your experience. Saturdays are a part of it. So, you know, Saturdays are almost kind of a more enjoyable day, even though it's a Saturday. We bring in breakfast, we bring in lunch, we have games, and it got real competitive this year. We call it the CK Cup Challenge. It was, I still don't know who won. I think they're going to announce that this week, but it was a lot of fun. And again, it's pretty formal. We have a lot of training. And we teach you honestly how to prepare these tax returns. Interns do a lot of this work. And to see the growth from when they came in, again, probably having close to no experience in tax, and I keep talking tax because that's my side. Again, there's a little bit of audit that occurs too, but to see them when they're done with the internship and the ability to prepare their own returns, their family and friends returns, you know, obviously it's not really quite in here, but to be able to do that. But clients, I mean, they're seeing all different kinds of situations, retired people, people who own their own businesses, Schedule Cs, people that get K1s, brokerage statements, you know, people that have things with Merrill Lynch and Schwab, and knowing what to do with these statements. It's just really amazing to see how much a person can learn in 3 months. So that's kind of our internship in a nutshell. And I think I mentioned that it's a paid, I think it's competitive for firms in the western suburbs. We do sometimes take on interns throughout other periods of the year, but it's not as formal. And I don't feel like the work is quite, you know, it's concentrated January through April. So it's just a really good experience during that time frame to be able to do so. I don't know if you have any questions for me, Mark, that I can share some answers with the group.
Yeah, you're talking about the internships are really important, and you're saying that a lot of times at the associate level, that's where the hires come from.
Absolutely.
So how do they actually apply for an internship?
Sure. So we've got an add-on on Handshake, and I can pass you the information on the application as well, that you can share. But I know we've got it out on Handshake. We go to all the career fairs. But we're really trying to right now gear up for next year. Some of our interns this year were juniors, so they're going to come back. A couple, I think, are coming back next year. But we've got room for sure, and you know, looking for good people.
And now, do you encourage them to come in as, say, juniors? Is that common?
And it's the nice thing is we've had a few students who've done that. And the beauty of it is they kind of become intern 2.0 or senior intern, as we call them. Yeah. So, you know, they potentially have the chance, again, if they enjoy it, we want to make sure it's a good fit. If they've enjoyed it, they come in the second year, they're able to kind of be senior over the new class of interns. So, you know, we had one of our, I call him senior interns, was teaching a lot of the classes. I mean, he grasped it that quickly. You know, he's joining us full time in a couple weeks when he graduates. But it's really nice to be able to, we've had, I think, 3 students recently that have been able to do that, to come back twice. So yeah, for, you know, for juniors or seniors, I think it would make sense, as well as grad students, if, you know, you're still undecided or just trying to go to school at the same time and make some money. Overtime is part of it too. So if you work over 40 hours, it's time and a half, I believe. Don't quote me exactly, but I'm pretty sure that's how that works. And, you know, I've seen them, the work is there. If you've got the drive and you want to make some money and you want to learn, you know, it's beneficial for us. It's beneficial for the students as well. So that's also another good piece of it, is to, you know, you're able to make some cash and learn and figure out kind of your profession at the same point.
Yeah, and so it's a 4 month, basically.
It's really 3 months, January through April. Yeah. So it's mid-January through mid-April. So it's like a full, it might be a little bit more outlying in between, but like we've had ours stay on, I think their last day is Wednesday. They're doing like a filing project. We're trying to go full paperless, so they're helping out with some of that right now. But it just depends on that particular year. If there's like a project we need help with after, or things that are lingering, then we kind of look at it every year to see, you know, how close after the 15th, or this year was the 18th, does it end? and that's how that works.
And is the audit a little bit different? Are they like November or something?
So audit, I think we have at least one intern, and that's more of a summer position because we have employee benefit plans that are big during the summer, and oh goodness, what is the other not for profit. So
Oh,
those are kind of like off, not typical 12/31 calendar year end audits. So I think we've had one, occasionally over the summer for that specific role. But other than that, it's highly taxed, a little bit of audit, and then it's always circumstantial.
okay. Okay. Yeah, well, no, that makes sense. I actually know that there's CPA firms that specialize in not-for-profit governmental stuff, and their busy season is like summer through.
Yeah, and for employee benefit plans, their year end is 10/15. So, or they have to file, the 5,500, I believe, on 10/15. So the audit is built into part of that. So that's a big deadline for employee benefit plan audits too.
Well, that's good. And you said so these are paid.
Absolutely.
Well, how much?
I want to say right now it's in the close to the mid-20s per hour. So
Oh, okay.
yeah, I don't know the exact at the moment.
I mean, put you on the spot. I was just
No, that's okay. That's okay. HR is the one that hands out the letters. I mean, I
Right.
do the interviewing for a lot of it, but then they take it from there. But yeah, it's in the mid-20s dollars per hour, that is. And then again, with overtime, the ability to do the time and a half.
Yeah, and I can definitely vouch for the internships that it's like the amount of learning that happens in an internship compared to a classroom is night and day. I mean, it's
And there's tons, it supplements it, which is the best part of it, because I mean, I still remember sitting in, and I graduated in 2000. Okay, it's been a long time, but I still remember like sale of a house rules and learning those in class. But then it just takes it that step further, because it's one thing to learn them, but then when you apply them, and you see how they work, that I feel like that just takes it that extra step. One other thing I didn't mention either is our open door policy. We really do have, I mean, I call them kids, but we've had our interns come in, and I'll talk them through this. Okay, this is what happens when you sell a house. Let's look at a closing statement. Let's figure out the real estate taxes. What's deductible when you buy, when you sell? How do you do that computation? Quite a few had those. We came in, we went through them. We kind of have like a little chain, like first the group asks questions amongst each other, because some may have seen, okay, I've had a lot of kids in college who have, or parents with kids in college who have 1099s and things like that, and tuition credits. And somebody may have seen a lot of retired people, and they're dealing with Social Security, and is it taxable in Illinois? It's not, by the way, and things like that. So it's like they were able to bounce things off each other. They kind of sit in an area that's more kind of lower desk space areas, and I'd always see them bouncing back and forth to each other, which was pretty cool. And then, partners, they go in to talk to partners. They talk to the managing partner, Deanna Salo, who is, our first, I think, female managing partner, which is pretty cool. But she's always, willing to sit down and teach somebody. And we're all the same. So, whether it's a staff person, whether it's a partner. We also do kind of a buddy system, so that each intern is paired up with a buddy who's a full-time person. And then we try to meet with them weekly, see if there's anything that they feel, they need help on, or we're the point person. If something happens, they need to, school comes first. So if, they feel like they've got a test coming up, they need some extra time, we help them out with that. But we really do try to make sure that they don't feel like they're alone when they're doing this internship, that it's they've got the support that they need. And the feedback is all, for the most part, always been really positive. There's on our website, we've got videos. We're going to make of course, our new students who are leaving this year do a video as well, but usually they'll do some kind of video or something for the website showing what their experience was like.
Okay. Yeah, and one of the things too that is amazing when you go into actually doing the returns and things like that is, one of the things I always say is there's no such thing as, well, I don't say it, it's actually a fortune cookie, but there's no such thing as an ordinary cat. that every single client is that there's always something weird that happens, there's always some, and you don't know that though until you get into it and start just seeing them. Now, the CPA exam is going to start, they're changing it basically next year to, and one of the areas that you can kind of, call specializing, but one of the areas you can choose is taxes. And I imagine that if you took an internship,
Oh, yeah.
that would be the venue to go, would be a very good basis for at least a quarter of the CPA exam.
Absolutely. I can't even imagine what that would, if I had that, that would have been so helpful. Instead, I took it back in the day when it was, on paper in a building.
Me too.
People, the McCormick Center, I don't know if you took it there, but that's where I took it, and people were crying and it was crazy. It's not like that anymore. I talked to all my people here. It's just definitely not as intense. It's just different.
Yeah.
But yeah, that would help immensely, I think, with if they're drawing on that. And the other cool thing too is to see how the software works, with what you've learned and how to utilize the software to get the results that you want. That's pretty cool, hands-on, and to see if you like working with the software as well, because that's a huge part of what we do. There's softwares for everything.
Right. Did you say you're going paperless as your kind of goal?
Yep. So we've got a few programs that we utilize when we're doing dependent upon business return versus individual. We utilize a program called SurePrep for individual, and then we use Lacert for our tax program. They can somewhat speak to each other, but the SurePrep is kind of our file retention, so that when we're done, we've got a nice file with all the client's documents that look just like the tax return. But they get to learn how to do all of that. I mean, they've learned, it's just amazing to see how much they can learn in 3 months, and the fact that they're using it all, at least a few days a week, really reinforces it.
Yeah. Okay. What do you think the split is between your individuals versus business clients?
We're trying to focus more on having the individuals be connected to a business. So, but we do still have quite a few standalone 1040s. Volume wise, I would say it's probably 5 times at least as many individuals as business. So I know we're over 1,000 1040s, I believe, that we prepare. And businesses are not as many, but each business has multiple owners for the most part. We've got a lot of family businesses that we concentrate on, or small businesses. So, usually it'll be 3 brothers or sisters, or, a parent and a child, or, things like that are owning. And then we do, so we'll do, the cool part of it is that we do the business return, and we'll try to align the individual return with whoever did the business, if it makes sense, because they kind of get to know the family. And then they have trust returns. That's also part of it too. And then it helps, when you graduate, to understand, when you're working full time, then you get into the planning phase of things. So it's nice to really have kind of that group of, one client that you're working on together. And as an intern, you would get to see pieces of that group.
So a lot of these like sub chapter S. Okay.
Yep, LLCs. We don't have many C Corps anymore, just a handful, but it's mostly sub S and then LLCs. LLCs is big because there's so much flexibility when you set those up, but S Corps are more rigid but easier to administer. So it just depends on the desires and avoidance of SC tax, how much that plays into it too.
Yeah. Okay. Does anyone else have any questions? And I will say one thing about taxes versus audit. Now I come out of auditing, but
and I did one audit in my life.
oh no, and that is that people who tax accountants are generally viewed as more valuable than most of the other accounts. When you're in auditing or regular accounting, they kind of look at you almost like your overhead sometimes. And for taxes, those are actually people that plan, that save money, that get us money back, and all that kind of stuff. So you really do get looked at differently in taxes, just in general. But tax professionals get looked at differently than audits, yeah, it's required, we have to pay it. They're here, and accounting's the same way, to some extent, like, okay, we don't make money on our accounting department, or we shouldn't make money on our accounting, so yeah, it is a little bit different. Now, if the people that go into this, to working with a CPA firm, do you have people that actually that would leave and then still, but still have a contact with those people and?
Oh, for sure. So we've had some, it's interesting. We've had some that have left and gone to industry. The hours are different. Usually there's still going to be a busy point. It's usually monthly. It just looks a little bit different and it's more repetitive. With public accounting, you're doing something different all the time because you're working on different clients. And at least, rather than a big firm, you might always be on one or two big clients. It just depends on what you choose. Here at a firm of this size, the nice thing is if you really don't like one project that you're on, well, okay, in a week, you're going to be on a different project, or in a day, you're going to be working on something different. So that's kind of the nice piece of it. We've had some people who have left us and come back. It's kind of like the grass is always greener. And we just had one who just came back and she went out to industry and then realized she was bored. She just wasn't learning. And she came back and was a great addition to have back. I saw growth. She wanted to be here. Like it was just, again, another really good part of our team. And that has happened a few times. We always maintain good relationships with those. And it's like a family atmosphere. So for the most part, I talk to a lot of people who've left for different reasons, whether they've moved or whether, some have their spouses have gone to different states, things like that. Or again, they just wanted to do private. It just fits in a little bit better maybe with their family lifestyle. But we always kid around about having a reunion, and every now and again we will get together and go out for drinks or do whatever with those that used to be here, because we still remain friends.
Yeah. I kind of went through that myself when I stopped auditing. I went to work as an accountant. And like the first couple months weren't too bad, but then when you stop learning, it just becomes you're so used to doing different things all the time, and some people hated auditing because of that. You're never 100% sure when you walk into a situation or whatever. Right. Same with taxes. I mean, you don't know what's going to happen even with the same client from one year to the next. And so, but again, some people don't like that. And occasionally, I guess I wouldn't either, but I tell you, when I got into the where we just do the same thing every day, it was really rough, to go through that. So
and it's not like that at all. And even in tax, like just from that perspective, I'm still always learning, and I've done it for, and I would always be like, gosh, I just don't know enough. I don't know enough. And you'll grow and you'll learn. And it's just amazing to see, okay, you start out doing a lot of the, the nitty gritty tax work. And then as you know a little bit more, well, you teach others in your firm. So that's something else you can do. You kind of become a teacher. Okay. Well, then you're, talking to clients. And a lot of times too, even with our interns, you have the ability to talk to clients, just depending on what, the project is and who they are. But the more you know, the more you kind of are able to speak with clients and educate them as well. And then, you're able to look at a thing and then advise them on saving money, or if they're looking to sell a business, okay, here's some things you need to look at, or buy a business. And, I never thought I would get to that point. Also, kind of analyzing tax law. I never thought that would be something I enjoy. And, it's a huge part of then trying to make a decision for a client. And if you can kind of take a stance on something, okay, well, here, let's support this. So it's kind of neat. It's not just, sitting down at a computer all the time and not having social interaction or things like that, but really between your coworkers, clients, it's much more sociable than I thought. And, it can go in a lot of different directions.
Okay. Well, thank you so much for meeting with us. And so you said that the applications are on Handshake.
Yeah, you know what? I will send you an email with the links to that. I'll have
Okay.
Nicole send you that as well as with my information. If there's any questions, anyone wants to reach out, by all means, please do. You know, I'm happy to give any perspective that you want, you know, as you're going through school and trying to make some decisions or thinking about an internship, I'd be happy to answer.
Okay, well, thank you so much for taking the time and
You're welcome.
really appreciate it.
Thank you.
All right.
Thank you.
You're welcome. Bye-bye.
Hello. I'm all blurry. Hold on, give me 1 second. Okay, I'm still blurry. Oh well. Yeah, so that it's a being in a CPA firm, whether it's with a you know, taxes or consulting or with auditing. One of the interests, there are a couple things that she talked about that are true, and that is that you get all these different clients, and they're all different. They're all different jobs. You know, you're in auditing, you'll have all different types of clients you meet with, people you meet with doing, you know, doing those audits and stuff. In the same way with taxes. I think one of the things that I was really struck by when I started doing auditing was how she talked about it, how social it was, how many times you're meeting with people and, you know, different people and all that sort of thing. And it is somewhat, you know, you're never exactly 100% sure when you walk into a place what it's going to be like or what you're going to be seeing. So, and again, some people like that. I think I kind of like that. I didn't realize how much I liked it until I left it. But you know, and some people just don't. I mean, there's nothing wrong with that at all. There's a lot of people that say, no, I want to know what I'm going to be doing. You know, I want to be an expert in what I'm doing, and I don't want to walk in and not know anything. You know, so it's just kind of different. You know, to figure out where you want to be. But another neat thing though about being in a CPA firm is you get to see a lot of different things. So you get to see a lot of different ways that you can, you know, that there are people working in your field. And you can say, oh, that looks interesting to me, or that doesn't look interesting. You know, it's better to see it and not jump into it rather than jumping into it and say, oh, this is terrible. But anyway, during the busy season, you're going to be working quite a bit. And like you said, like, you know, it's $20-some an hour. So, you know, your internship is, it's not like you're going to be spending all day there and not getting paid for it. You usually come out making, you know, some decent money out of it. But anyway, I'll when she sends me the link, I'll go ahead and forward that to you guys, and I'll also put it on Blackboard. Any questions or comments on that? But I think, you know, seeing her, you know, she's a tax manager. I wouldn't be surprised at all if she became a partner. It's as you can tell, she's very sociable, very polished, very, you know, all those things that would make people want to do business. And so, and that is one of the things too about CPA firms, is that they are generally kind of like, they're like owning your own business. You know, so a lot of times, and they can be very lucrative. It would not be surprising for partners in even a smaller firm like that to be making, you know, well into the 3 digits, or even more, depending on their clientele and how much billing they do. So CPA firms are generally the highest, in general, the highest paid of all those. So not that that's the only deciding factor. Anyway, any questions on that? Okay, well, let's go ahead and what am I doing here? This is the handout that I sent out earlier. Let me get rid of that for a second. Okay, tonight. Oh, we'd already had Natalie. Okay, I think I'm going to jump into the sampling practice exam. I think we'll do that first. I don't think there's very much left to do on that one. Okay, right. So we did the test of controls in a mean per unit. By the way, one thing about the test of controls, and that is the allowable versus the upper limit. Oops. The reason I'm telling you this is because this is where the test people would sometimes anyways have trouble. Say this one was 8%. Add something like this onto this one. Okay, so let's say we have this situation. This is what we have up here. The allowable rate is 6%. The upper limit is 8%. Are we going to increase substantive testing or decrease it? All right, let me put it as C. So if we have an allowable rate of 6%, so we'll allow up to 6%, but our upper limit is 8. What are we going to do with substantive testing? Increase it, decrease it, or have it unchanged? Yeah, are you guys sleeping? You're not supposed to do that till the second half of class. No one? Come on. You can put it in chat if you want. So we decided the allowable amount would be 6%, but the upper limit is 8%. So this is when we did our testing. We came up with this upper limit of 8%. So what are we going to do with the substantive testing? So those are test of controls. Anyone? You can put it in the chat. You can private me in chat if you don't want to say it out loud.
Would it increase?
Yep. Yeah, you have to increase substantive testing because you can't rely on the controls. Okay, so if the upper limit, if this is greater than, no, other way around, sorry. If the allowable limit, if the upper limit is higher than the allowable, then you have to increase the testing. Now, let's take the conversely. And on the test, you get either one. You know, let's say that we had an allowable rate of 9% and the upper limit was found to be 5. Oops. Let me get rid of that. So now which one would it be? So you're allowed 9, you do the testing and you only come up with the upper limit is 5. So you're pretty sure the controls can be relied upon. So we can't rely on controls. Now, are we going to increase or decrease or leave the substantive testing unchanged? Yeah, probably decrease. That's quite a bit. The difference between those is quite a bit. You could probably, if you find out the controls are really working well, you can actually decrease the substantive testing. You're going to rely more on the controls. Okay. And then the last one, if the allowable limit was, say, 7 and the upper limit was, say, 6, that's pretty close. Or if these are both 7s, something like that, at that point you might say, okay, we can rely on them, but just, that it's, get rid of this other one here. So if these two are close, or equally, let's say, the allowable 7, the upper limit is 7, something like that, you're probably not going to change it too much. Only when they're a big difference here, when they're close to equal, or if they are equal, you're probably going to say, okay, well, we're probably not going to change the amount of testing because they're pretty close. So anyway, these test of controls. Now, the reason you're doing these test of controls is so that you can decrease the substantive testing. And these are not required. It is possible you say, look, I'm not going to do the test of controls. Maybe I don't feel like I can trust the test of controls. Maybe last year I did the test of controls and I couldn't trust them. It is possible just to say, okay, we're just going to increase the substantive testing. I don't, if you don't want to go through this with test of controls and do the testing of it, you can just say, look, we're just going to do a bunch more substantive testing and not do test of controls. So test of controls, the only reason why they do them is to reduce the cost of the audit, basically. Reduce the time, reduce the cost of the audit. One thing that is, whether it's taxes or auditing or whatever, there's usually a time crunch, and if you can save time, you will. Okay, classical sample weight, that's pretty straightforward. Okay, let's come down here. Monitor unit sample. Okay, be careful on these. The risk of incorrect acceptance makes a difference as far as which, what the amounts are. Okay, so we take our total book value, which is 500,000. Oh, it is bolded already. Okay, I'm gonna make it a color. I was gonna say, this looks small. It is small. It's only 10. Why do I have the font as 10? All right. So the book value is 500,000. The tolerable misstatement is 30,000. The expected misstatement is 1,200. Oops. Okay, and now we need to go to find our reliability factor and our expansion factor. Okay, so 10%. And so this is for sample size. Row 0 is used. So reliability factor will be 0.3, scratch that, 2.31. And the expansion factor is nice and easy. There's only one, it's at 10%. 1.5. Okay. Oh. You know, I usually do the bottom first. Oh, whoa, that's the wrong number. Hold on. A little bit of overachieving there. Okay. $1,800. 28,200. Okay. It's 41. So what you guys got?
Yeah, approximately. Yep.
Yeah, I rounded up to 41. Okay, and down here we have our total book value, 500,000, and we're going to break this up into 41 pieces. Oops. So each interval would be 12,000. I'm going to round off to the nearest dollar. 12,195. And feel free to do that on the test. Okay. So the sample size and the sampling interval, those are connected. So the first item we'll take is the item that crosses 12,185. The second will be the one that crosses 24,000, whatever, 490. No, 390. I don't know. Yeah, so you know, the nice thing about this method is not only does it tell you the sample size, it also picks the sample for you with the sampling interval. And anytime if someone cooks the books over the sampling interval for any item, it's 100% sure you're going to catch it. So this is really a good method for overstatements. Okay. So here is one, and by the way, this is similar to what I've seen on that they've given on the CPA exam. I haven't seen it lately, but oops. But when I was taking it, they did have ones that were similar to this on the exam. Okay, and we have 3 of them here. I should have numbered them. I'll number them now. Here's number 1. Here's number 2. And here's number 4. I'm just kidding, it's number 3. Okay. Okay, number 1 is kind of a wacky one. Why? what's odd about this one?
The audit value is bigger than the book value.
Yep. This is an understatement. We're not supposed to find these. This method is not supposed to find those. Extra room here. So what do we do when we find an understatement? I get it. Yeah, you're ignoring me. So yeah, that's what we do. We ignore it. There is no understatement here. And as an auditor, this kind of bugs me a little bit. But there is no misstatement because this method is not supposed to find understatements. When it does find them, it says, oh, that's not what we're looking for. So projected misstatement for this would be 0. It's not an error. Okay, let's go to number 2. Number 2 is pretty straightforward. This is an overstatement. They have 200 other books. We're saying it's only 40. So this is an understatement. So our projected misstatement will be whatever that is. Okay, so projected value is 1,000. So what is the projected misstatement on this one? So we're saying of that $5,000 interval. That we're thinking that it's only worth 1,000. Yeah, we're thinking we have evidence that it's only worth 1,000. So what's the projected misstatement on that one?
4,000.
Yep. So projected misstatement on that one is 4,000. And that's kind of a normal one. I don't know if you call it normal, but that's what it is. This is the way it usually happens. It's a ratio times the interval. Okay, third one. What's wacky about the third one?
The book value is larger than the interval.
Yep. This one, the book value is larger than the interval. Now, this is 100% sure we're going to pick this one. Because if it's larger than the interval, it's going to be in at least one. It may even get picked twice. Now, when that happens, we go to the actual misstatement. Because this is higher than this, we go to the actual misstatement. So we're going to take the 5,700 minus the 4,500. So we're going to take the 5,700. This is the actual amount. And and this is this is math 101. You put the comma in the right place. But now we're going to subtract the 4,500, not the 5,000. The 4,500 is what we're going to subtract. This is what we came up. You know, they're saying it's 5,700. We say no, it's only 4,500. And so this thing is misstated by 1,200. Does that make it more? It might make it more confusing, but okay. So this is the amount that we are going to put in for that one. Let's make it yellow, I guess. Okay, so this is 1200. All right, so the first one's 0. It's an understatement. We ignore it. Second one here is 4,000. Third one's 1,200. So our calculated projected misstatement is 5,200. Okay. Calculate the basic precision. Now, basic precision is if there are no misstatements, it's still possible that this is off by some amount because it's a sample. Unless you take 100%, it's always going to be the possibility that it's off by some amount. And so that's what this basic precision says. That, look, even if you don't find any errors, there still could be errors in here. Even if all of these were zeros, it's still possible this could be off by some amount because it's a sample. So we take the sampling interval, which is how much? How much is our sampling interval?
$5,000.
Yep. So our sampling interval, just this. We should get more colors to work with here. We only got like, nah. And it's so weird because in like Excel, they have this huge palette. Here, you'd think that it'd be just the opposite. Like in Excel, they'd only have a handful, but all right, enough complaining. And we have to go find our reliability factor, add 0 overstatements, and that's down here. You know what? I got to figure out what. Okay, we're still at 10%. Make sure you check this on the test, because some of them will be at 1, 10, and 5. Okay, so this is at 10%. Make that color. Okay, so 231. So this will be get those. I got those quite a ways apart, don't I? 5,000 times 2.31. $11,550. Okay, and again, this is the number that, hey, if nothing went wrong, it could still be off by that amount. Now, incremental allowance. Incremental allowance is when things could go even worse. And that is, it has to do with misstatements up here. And the idea is that if there are misstatements, that things could get even worse in those separate intervals. When you find a misstatement in an interval, that means that interval could have more misstatements in it. Now, it makes a difference how big the misstatement is. A little misstatement is not as bad as a big misstatement. So, as we go through these, which are included in incremental allowance, this first one obviously isn't. It's not even a It's not even a misstatement at all. So this first one is a no, and it wouldn't even matter if it was, because 0 times anything is 0. Now, notice the second one. You know, this was only 200 of the 5,000. This means, you know, this item only took up 200 of the 5,000. Only took $200 of the $5,000 in this interval. The point being is that there could be a lot more things wrong in this interval. Right? I mean, this only accounted for 200 of it, really. So this could be even more than 4,000. It could be that there's more off because this is only $200 worth of it. So this one will be included in the incremental allowance. This one, and this is when the book value is greater than the interval. Notice there's no dollars left in this interval once you apply this book value to it. It takes up all 5,000, actually even more than the 5,000. It takes up the entire 5,000. There's nothing else that could go wrong in this interval. This book value covers the entire interval. This one will not be included in the incremental allowance. So this incremental allowance, there's only going to be one in this incremental allowance. And that's number 2. You know, look at all the colors I get for this one. Of course. So this is the only one that's going to be included in the incremental allowance. All right, so we come down here, we really only have to do this first one and this one. If we had these other ones, we'd do those too, but you know. All right, so what we're going to do is take the incremental allowance, and we have to do the increments from one misstatement, which is what we're looking at here, minus 0, so the increment. So 389 minus 2.3. And don't forget the minus 1. All right. So 0.58. And we're going to multiply this by that 4,000. So this is the incremental amount that we're multiplied. 4,000. Did you guys get the 0.58? So 320.
Yes.
Okay, thank you. Okay, so this is the Incremental allowance is just that one. That's the only one that could get worse. All right, so here's the total upper limit. Now, this is our best estimate, is what it's off by. So the best estimate is that it's off by 5,200. However, it's a sample, so it's possible that it's off by more, and that's what we're going to look at for the upper limit. And we'll clean this up in a second. I'm getting rid of these two. We don't need them. Okay. So we're going to take all three of these and add them up, and that's going to be the upper limit. $19,070. Oopsie. Or Z, as I like to call it.
Professor, can you repeat one more time how we calculated the upper limit on the mistake?
So which one? The incremental?
No, the upper limit. Oh, we added. Oh, never mind. Never mind. I just
Yeah. No, it is wacky. So these things. Now, if you didn't have any errors, if there was no projected misstatement, if this was 0, or if the only one was like number 3, where you didn't have any incremental, you wouldn't have any of this incremental. It is possible you don't have incremental allowance. You're always going to have this basic precision, though. No matter whether you have misstatements or not, you have this basic precision. So this is the upper limit, and this is what you would compare to, see whatever you worked out for your materiality before you did the testing, and see how it compared. What was the total amount here? So this is 400,000 is the book value. So this is our upper limit is 19,000. So I guess it's a judgment call whether this is, whether it's a material misstatement or not. And on the CPA exam, they're not going to ask you, because that's a judgment call, and basically whatever you say they'd have to take it, and they're not that generous. Yeah, so this would be the upper limit, and this is what you would use. Your best estimate is 5,200, but it could be off by as much as 19,000. Here's a question for you. How many items were in the sample? I asked a question I don't know the answer to. Okay, now I know the answer. How many items did they have in their sample? We know.
80.
Yep.
80.
Very good. Yeah, if you divide this by the interval. I'm gonna copy this. You get the number of and this would be something that they may give you on a like a multiple choice question. Like how many total items were sampled or something like that. Well, all of the which is a sample size. There we go. Yeah, so if the intervals were 5,000, they must have picked 80 items, and these were the 3 they found with errors. This first one was an understatement. We ignore it. Second one was what we, I would say the normal process one, and the third one is one that was definitely going to get caught. And that is it's bigger than the interval. And this, by the way, is one of those things that, if, like I say, if they increase, if they cook the books enough, you're gonna find it. So that's that's the beauty of this method. For overstatements, it's great. Understatements is worthless. But overstatements is great. In fact, it's so worthless for understatements. When we find understatements, we ignore it. But overstatements, it's good. Okay, let's go ahead and save that. And I'm going late here. Okay. Well, we'll come back. We'll start in on. So I'll send this exam out tonight. So the sampling exam I'll send out. It'll be due on the 5th. I think this class actually goes till. It's supposed to go all the way to the 8th, I think. But I don't think we're going to do that. And I'll talk about that when we come back. Okay, so we'll start back up on this when we come back. Oops. Okay, so let's say be back at we may not finish this one. 7:20. Okay. Okay. I want to just talk a little bit about auditing. I know I said that auditing, they kind of look at you a little bit like your overhead, and for external auditors, they kind of do. I was actually an internal auditor. I was inside a company. I worked for Navistar and US Steel. And internal auditors we actually a lot of times would save money for the company. So we were actually kind of looked at a little bit differently than most. And that I'll give you an example. The largest actual cash recovery I ever did was just under $500,000, which was way more than my salary. So, we definitely paid for ourselves doing the internal audit. I worked with a woman who she literally had recoveries of close to $20 million. And you're talking about, this was years ago when $20 million is worth more than $20 million today. But anyway, so a lot of times internal audit it's a good, you do a lot, you learn a lot, you do all kinds of audits, and not just financial audits, but all kinds of audits. I audited human resources. I audited a part of my audit was doing IT stuff. You do all kinds of stuff a lot of times in internal audit. And in the past, they used to have a lot of travel. I would have to imagine that nowadays it's probably much less because more things are computerized. And obviously, like we're doing, a lot of times you can meet with people without actually flying to Montreal or wherever. So it used to have a high turnover because of that. The travel was so extensively. When I first started auditing, I was in the office for 2 or 3 weeks. And then the rest of the year I was on the road. I was on the road literally until like the holiday break in December. So nowadays I think that there's much less travel involved, but those jobs still come open, and again, they're very interesting. They're not comfortable jobs. You're always, you walk into a place, you're always when you walk in, you're the most ignorant, and sometimes when you walk out, you're the sharpest on it, whatever they're doing. So it's not for everybody, but it's a good job, and you get to see a lot. And there are still places I'm sure that they have you travel if that's what you want to do. Those jobs they're out there, the internal audit ones. If you look at my designations, there's a CIA. That's not the Central Intelligence Agency. That's a certified internal auditor. And I got that when I started doing internal auditing, when I went to an office that had a bunch of people that had that CIA designation. So, when in Rome, I went through and took the test for the CIA exam to pass that so that I could, so I had the same designation that everybody else had. So anyway, internal audit is a good one though. I liked it. At the time, it was a lot of travel, and it's I was getting married. It's really hard to hey, I'll see you in 10 months. So anyway, okay, risk assessment. So risk assessment, you generally look at what things can go wrong. And they've broken this up into 2 different levels. At the assertion level, which we're kind of used to, and we'll talk about that. And then the financial statement level. The assertion level is kind of what we're used to thinking about. And that is, what's the risk of an account being off by? And you'll sit there and brainstorm, how could the inventory account be off? And you'll go through and try to figure out where the problems could be. And you're doing this so that you also think about, how would I find it? Okay, if it's possible inventory is being stolen, lost, broken, whatever, how do you find that? How do you find where those things are? So the risk assessment is really saying, can it what could go wrong? And then you're going to figure out how to find it if it does. So first thing you figure out is what could go wrong. And that's kind of where this risk assessment is. Let's put that up there. Do here. What could go wrong in an account? So risk is seeing what's wrong, and then later on we'll do a design test to come up with it. And so that's what, said down here, design testing controls and substantive procedures. This actually comes after the risk assessment, but that's kind of the goal of it is, okay, how do we see if any of these fears that we have are coming true? How do we test for that? Okay. Now, there also is this at the financial statement level. In other words, risks that are not to any given account, but at the financial statement level, that the entire financial statements are sort of at risk. And these are some of the things you look for. Bold these. Management incompetence. Anytime you have management that isn't competent, you have that possibility that they might be counting something as a revenue, say that isn't revenue. Or oversight by the board of directors. The board of directors are supposed to be keeping tabs on things. A lot of times they're not. A lot of times they're just rubber stamps for people in charge or something. So sometimes you run into that. Inadequate accounting. These two kind of go together. Why is the company more risky if, say, that they're having troubles financially, the economy is going down, or they're in bankruptcy? Why is that a risk? I mean, a company going bankrupt, they could prepare their financial statements, fairly. Why is this a risk if either the economy is doing worse and the company is doing poorly, or if they're going into bankruptcy? Why does that increase the risk? I mean, honest people go bankrupt, whatever, for whatever reason, you can be perfectly honest and go through bankruptcy. But why is it a bigger risk at the financial statement?
Could it be a potential for fraud? I mean, even though honest people.
Yeah, you're exactly right. There is more of an incentive for fraud. If a company is doing very well, there's less incentive. I mean, not that it can't happen, but hey, we're doing great, had the best year ever. Yeah, go ahead and go the books. If your company's doing poorly, they have more incentive to try to cook the books, and it might even be one of those things that that even somewhat honest people get into, and that they say, well, look, if we don't cook the books, we're not going to get the financing. If you don't get the financing, I'm going to have to lay off all these people. And and not necessarily they're even evil, but there are times that people get in those desperate situations where sometimes they make decisions that aren't the best. Anyway, there's more incentive for them to cook the books, rather than the company is doing very well, had people lining up around the block to give them money and invest in their firm. Someone who's going through bankruptcy, or if there's a downturn in their business, they may have more pressure on them. Obviously, rapidly changing industry. And this one is a very important. One domineering executive. Almost always when you run into the large scale frauds, you can almost always boil it down to one person. It's one person with a really bad idea, and those people get everyone else on board. So one domineering executive, if there's an executive that pretty much calls the shots for everything, that's a problem. And it can be a problem for a number of reasons, but as far as we're concerned, as far as auditing is concerned, it's a problem because you may have an executive that may make demands on those in the company that would normally not be made by someone who's not domineering. All right. Auditors are required to assess the risk of management fraud. It's kind of funny. This is one of those things that in the past wasn't really said. It wasn't really actually said that you're actually looking for management fraud, but you're required nowadays to look for management fraud. In the past, we were always required to look for misstatements, whether they were fraud or errors. We've come around a little bit more on that to more of the reality of the things, especially in large companies. You have a large company that's been around for years. If there is a material mistake, is it more likely to be fraud or is it more likely to be an error? And it goes along with this. A lot of times material misstatements due to fraud are harder to find. Why? Why are material misstatements due to fraud harder to find? So someone cooking the books for, say, $6 million. Let's say they cook books for $6 million. That's gonna be harder to find than if someone buys a $6 calculator and they put it in as $6 million, so there's a $6 million error on the calculator. The $6 million error on the calculator is gonna be a lot easier to find than the $6 million fraud. Why? Why will the fraud be harder to find? So someone fraudulently decides to manipulate the books for $6 million rather than, oops, putting in $6, get a phone call, put in 2 more zeros, okay, 2 more zeros, okay, get another phone call, and pretty soon you got a $6 million calculator, you enter it into the system. That's probably going to be fairly easy to find. Because if for no other reason, it's going to hit somebody's budget. There's going to be some office person that says, well, why is there $6 million coming out of my budget? So that one would probably be easy to find. Why will the actual management fraud be harder? So someone decides they're going to cook the books for $6 million. Why is that going to be harder to find? Anyone? You can put it in chat if you want. And by the way, this is why they talk about that we have to look at specifically for management fraud, because of this very idea. When management cooks the books for $6 million, are they going to make a journal entry for that?
Probably not.
Probably not. No, they're going to try to cover it up. You never see this. You never run across a journal entry like this. They cover it up. Yeah, you don't see fraud expense. They put this into something else. Whatever it is. Some kind of an asset account or something. So you know, it's never, whereas errors are just errors, and you know, a lot of times they'll be caused, a lot of times people won't even be able to enter it. I try to enter my calculator for $6 million, the system kicks it out and says, there's nothing in our inventory that costs $6 million. You can't enter that in there. You know, whereas management fraud is much more difficult, and it's the more risky of them, because management is much more likely to try to conceal the fraud. They're not going to jump right out and tell you, hey, we just cooked the books. Management is much more likely to conceal the fraud. And especially when you're talking about large companies, with small companies, okay, that, you know, it's probably not as sophisticated, but large companies, one of the things about large companies is a lot of times the people in doing the financial reporting are people that came out of auditing. They came out of CPA firms. They know everything you're going to look at. They've done it. And those are the people that are there all year long. You're coming in for 3 or 4 weeks, maybe, to try to figure it out. So it's a real, you know, risk, because again, you get people that know what they're doing, they know how to conceal it, and they're there all year round to think of ways to keep it from you. And they know exactly what you're looking for. They've been in the same spot. So that's why it can be difficult to find. That's why you're really on your toes looking at management fraud. Because if that does happen, it's a real problem, because you have to try to, you know, you have people actively concealing it. And again, these, you know, especially for large companies, these are not bumpkins that, you know, rob gas stations. I mean, they're people that know what they're doing. Okay, risks. Okay. Inherent risk. I think we talked about these before. Inherent risk is the risk that is a risk that a material misstatement will occur. So inherent risk is risk that a material misstatement will occur. Control risk is the risk that the client's controls all right. Control risk is the risk that the client's let's say internal controls yeah, you know what, that looks funny. Okay, so control risk is, so the first risk is, will the client make a material misstatement? The second risk is the risk that the client's internal controls will fail to identify material misstatement. Detection risk is the risk that the auditors will fail detect material misstatement. I'm gonna put this. I know, I'll do it like this. Okay. So inherent risk is the risk that a material misstatement will occur. And control risk is a risk that the client's internal controls will fail to identify. These first two, these are the client's inherent risks. Okay, so I'm going to make these yellow. So these are the client. Detection risk is these are the auditors. And these are the only things that the auditor has control over. Yeah, let's make that green. So inherent risk and control risk, these are the clients, and that's the only thing the clienter has. Let's call it the clienter. The clienter has control over that. The auditors have control over the detection risk. So this is when we try to audit to the 95% level or 90 or 90, whatever it is. That's the detection risk. Now, a couple of things about inherent risk and control risk, and then go down to detection risk. We cannot change the inherent risk or the control risk. So this is assessed. The auditors will make an assessment for it. And but as far as the actual, as far as actually changing these, we can't. We can't change what the inherent risk is, the actual inherent risk or the actual control risk. For a couple of reasons. First of all, the client has control over those things. You know, they'll have control over their people and whether they make material misstatements and all that kind of stuff, and that they have the controls that'll identify it. Not only that, as an auditor, we're looking mostly at historical data over the last year. How much in sales did they have over the last year? How much in expenses they have over the last year? So we're looking backwards. Now, if there was a problem with the inherent risk or control risk over that period of time, notice we can't jump in the time machine. Even if we wanted to advise the client, we can't jump in the time machine and go, oh, let's go back to January so that you can improve these controls. The control risks were whatever, you know, whatever they were for the year, that's what they were for the year. The inherent risks, whatever they were for the year, that's what they were for the year. We can't jump in the time machine and go back and change it. Even if we were to advise the client, look, you should be doing this for internal control. At the point of us doing the audit, we do the assessment, it's done. You know, the whatever the inherent risk, whatever the control was for the year, it's done. Okay, so we can only assess it. We can't change it. The only one that we have control over is this down here. So the auditors have control over the detection risk. So we make the decision, you know, and whether we do the 95% level, you know, 90%, it's a judgment call. All auditing is judgment. So we have control over the detection risk. So this is the only thing that we have control over. We don't have any control over the inherent risk or control risk. We try to assess it, what it might be, but we don't have any control over it. Now, if everybody fails, we run into this audit risk. And audit risk is the risk and undetected material misstatement appears on the financial statements. So if everything fails, it's an audit risk, and that is that an undetected material misstatement appears in the financial statements. It's possible we detect it. If we detect it, we can alter our report and hopefully get the client to change their financial statements. But an undetected material misstatement, in other words, we missed it, appears in the financial statements. So it occurred and the controls didn't catch it. We didn't catch it. It appears in the financial statements. Okay, now there is a mathematical formula for figuring out the control risk. This has appeared on the CPA exam at least twice that I know of. And that is if you take all of these and multiply them. So I'm taking inherent risk we have down here 50%. So we're taking all of these. So inherent risk is 50%, and they say our control risk is 20%. Our detection risk is 30%. And that should equal our audit risk. Oops, forgot the multiplies in there. So 0.5 times 0.2 times 0.3, whatever that is. So our audit risk would be 0.03 or 3%. Oops, it's not a percentage. Now, I don't know that any CPA firms actually do this, but that is the mathematical kind of idea. You know, all these seem kind of high. Inherent risk is 50%, control risk is detection. Now, but here's the thing about this, when you think about this in fraud. And that is, if you're dealing with fraud, these first two will be 100% that they're going to miss it. Right. So if there's fraud, it'll look like this. It's 100% sure that they're going to miss it because they are planning on doing it. The controls are not going to catch it. Your audit risk is now 30%. In other words, it's kind of high that you're going to miss this. So when there's management fraud, this is why there's a problem with it, that you're going to be really up against the wall because this is Oops. Not spaced right. These two go to 100 when there's fraud involved. If they're 50 and 20, this is, even those seem kind of high, but it's down to 3%. Where those two go to 100. Now, the one thing I'll tell you about, and this is true of all things, and I know that we get kind of specific here, but when it comes to risks, and this is all risks, do you want risks to be high or low? When we talk about risks, do you want them high or low?
No,
Low. Right. You want their inherent risk to be low, you want the control risk to be low, detection risk, you want to be low. And certainly the audit risk, you want to be low. So lower is always better. Now, the only one we have control over is the detection risk. That's the risk the auditors could have control over. So, the first two, we assess those, but we want to assess them. When we assess those, we want those to be low. Now, we do test the controls, we might alter those. Maybe the controls are better than we thought, or better than last year. We can assess that at a lower level. If the controls are worse than we thought, bump those up a little bit. What does that mean? It means we probably have to do a little more auditing. And we know that because we're going to do more substantive testing. So anyway, let's stop here. Let me stop on here. Yeah, I'll put it up here. Over here. Okay, so I'm going to send out the I guess it is. I'm going to send out the sampling exam. Sorry about that, I sneezed. So I'll send this out momentarily, and we'll meet next week, finish up the handout on the controls, and that'll be the last exam. I'll make it something reasonable. There's a lot of stuff in here I can take out. Yeah. Okay. Well, we'll definitely finish this up next week, and probably within the first hour of class next week. And yeah, so I'll send out the sampling exam after class, and that'll be due on Friday, 5-5. So a week from this Friday. Any questions? Okay.
Yes.
See you guys in a week.
Have a nice
Thank
evening.
you, Professor.
Thank you.